Geared for Growth. I'm your host, Mike Mortlock from MCG Quantity Surveyors. Now, today I'm talking to a very special man. It's Mr. Mark Errichiello from Masters Advocates. He is the state member for Victoria for the Real Estate Buyers Agents Association of Australia. He's a candidate for the board of directors for the Real Estate Institute of Victoria as well, and he's been running a fantastic business in the buyers agent and property management space in Melbourne for a very long time. We have a chat to him, I suppose, in two parts. The first part is we talk about Melbourne. Where are the pockets that investors can be looking to get properties that have growth potential with reasonable yields? We talk about price points and how much you might need to spend to be investing in what Mark would consider worthwhile investment grade pockets in Victoria or in Melbourne. And then the second part of the interview, we're really talking about the political sphere at the moment. So as at the time of recording, the National Cabinet had met the day before talking about rental freezes and all sorts of minimum standards and land tax issues we're bringing up with Mark. And he gives us his assessment of the reason why Victoria has been less popular for investors and whether some of these announcements and these policies are likely to help solve the rental affordability problems that we have in Victoria and indeed the country. It's an awesome interview with Mark, which I'm sure you're going to get something out of. Here's Mark. Mark Errichiello, thanks for joining me on Geared for Growth.
Hey, thanks, Mike. Great to see you, and thanks for having me as a guest. Pleasure to be here.
It's a great pleasure, and I must say it's long overdue having you for a number of reasons, because you're really sort of Mr. Melbourne when it comes to property investing and investment advice. You've also been a real advocate for some of the proposed legislation changes, which I want to pick your brain on. But let's start with your hometown, Melbourne. I want to sort of get your sense of where the market is up to at the moment. If you look at the latest sort of CoreLogic data, you sort of see Melbourne is probably underperforming nationally in a marginal way. We're talking about it's 2% up for the quarter compared to 2.9% nationally, and annually it's down 4% as opposed to 3.4% nationally. What sort of, where are we at in the market in overall Melbourne?
Yeah, look, considering that the outlook was probably going to be more grim in the last 12 months, that's not bad. At least we're up rather than in the negative. And since March, you've probably seen that recovery in Melbourne, and also all the other factors. So, post-COVID, still recovering from the mass exodus and other areas of construction and government affecting interest rate changes, affecting everyone nationally, but definitely affecting investors in Melbourne as a whole, that we're looking at other things like the rental reforms and costs there, and other tax reforms and discussions. So, considering all of that, rounded sort of information, I think up 2.4, and it'll probably look better at the end of the next quarter, I'd say. Now, especially now that interest rates have been on hold for 2 months running, the sentiment is getting a little bit more confident, but
Yep.
we've got a long way to go. But still better than most of the leading economists were predicting.
Yeah, and I do want to get onto the legislation stuff soon. When it comes to price points for investors that really do have the whole country to choose from, and our own data is saying that people are buying further and further from where they live. Is Melbourne and sort of, I know we probably shouldn't say Melbourne and there's markets within markets, but let's talk about Melbourne, within sort of 10 to 15 Ks of the CBD. Is it still a viable option for property investors that have, $500,000, $600,000, $700,000 to spend? Or is the quality of asset that you need to get some good results and some good returns at a higher price point, which forces people to look elsewhere, do you think?
I feel that discussion of 5 to 10 kilometres of the CBD, that was always hot at the beginning of my career, like going back over 20 years ago. Now, for houses, if you're wanting to secure a house under 700,000 as an investment, that's good quality structure. Land you may not be large enough to subdivide, but you're still going to have growth potential. And following out that 20K to 30k radius, you can definitely still get assets that don't need too much invested to meet minimum standards for investment. Maybe some cosmetic appeal injected, $10,000-$20,000 to improve a property, and a decent yield for a house, 3 to 4%, following the main infrastructure, main train lines out of the city. You'll get that in the north and west, definitely, and then some further east, depending on the location, and some further out in the Bayside, probably closer to that 40 to 50 kilometre radius. But 10 or 15 Ks, you're probably looking at good size villa units and townhouses in established suburbs that can still lend to be good investments. That's what we're finding.
Yeah. And for people that don't understand Melbourne as intimately as yourself, talk us through these rings. So 5 or 10 kilometres from the city, is this a 10 or 20 minute commute, for the properties that we're talking, say 20 or 30 Ks, is the value of that really dependent on how close it is to a rail link or a link road?
Yes.
Help us sort of understand the geography of it.
Yeah, so from the CBD, Melbourne CBD, or Yarra River as well, if we're looking north side, for example, and northwest, the traffic and infrastructure improvements are still needing a lot of work and gain, because yes, you can be in gridlock and time, like 20 minutes in traffic or half an hour is probably more realistic to get within that sort of 30k radius. And it does build up as you go out to these new estates that have been developed in the last 20 years. Traffic does build up. So staying on the train grid, you can get in within that sort of half an hour period, and depending on the services. But I find that with suburbs, if you're familiar with the Western Ring Road, inside the Western Ring Road in the north and the west, that's where prices will heading south, coming in south of the Western Ring Road. That's where you tend to get a little bit more demand, more competition, where getting an actual house as an investment or to occupy under 700,000 is a little bit less likely. Will need work, or it'll be borderline knockdown or needing some major work and renovations or improvements. So you're going to have to budget for that, and not as easy to get funding for improvements and construction anymore.
Yep.
But going outside the Western Ring Road, just outside it, in the northern corridors, places like Laylaw, Epping, Craigieburn, in the west, just inside the Western Ring Road, Deer, Sunshine, and then heading out, you've got suburbs like Deer Park and heading further west can get a little bit more affordable.
Yep.
Or as far as Point Cook and Werribee, it's a bit further out, but still very affordable.
Yep. When it comes to the land supply, is there a point at which you go so far outside of Melbourne that you worry that there is a little bit too much land, so that there could be, quite a few house and land packages coming on the market that would influence the gains of the property? Or are we talking suburbs that you've just mentioned that they're actually kind of still sort of in a ring, and that's not an influence we need to worry about as investors?
Yeah, so the suburbs I mentioned are fairly established, and they were released from individual property owners or farmers over the last few decades, where there were little estates redeveloped by builders and land release where some custom builders came in for owners of the land. It's sort of a blend where it's not as obvious that you're in an estate, and they're well established now. But definitely going further out, when you start hitting that 45, 50 kilometre radius, I guess it's a benefit, as well as you can see it as a negative sometimes, that we've got so much land geographically to improve infrastructure and expand the suburbs, compared to other capital cities that might be a bit landlocked between the landscape to develop. But I would, yes, be careful with off-the-plan new estates, more so from the fact, unless you're willing to buy and hold and wait until that estate is developed, because for the first decade, if there's multiple builders and there's risks with new builds as well, holding and waiting for that to develop and get the growth while there's new estates new farmland, new estates being developed and released within neighbouring towns for the next 10, 15 years, you're not going to get much growth on your resale. You might struggle to get the right rental return when you've got a Lego city, so to speak, of the same build, same quality, oversupply for resale and rent. They're the risks there, unless you're looking for, large cash purchases where you're getting a return and depreciation. But I'd always buy for growth first in an established area.
Yep.
And depending if you've got the means to do it, if you've got if you can service that type of purchase.
Yeah, for sure.
So and coming closer in.
Yeah, and you're probably preaching to the converted as listeners of this show, Mark. We agree with you on that one, I think, wholeheartedly. I was recording a podcast yesterday, a different show, and we were looking at the Australian Property Investors Survey, the Property Investor magazine, and it was talking about the ideal yield from survey respondents, and it kind of sat somewhere around that sort of 5.5%, with the median sort of falling really between about 3.6 and I think about 6.6. So if we're looking,
good. I got your back. It dropped out for a few seconds there.
Oh, sorry.
That's okay.
I'll start that question again. I was recording an episode yesterday of a different show where we were talking about the Australian Property Investor Survey, and they were talking about the ideal yields as nominated by survey respondents, and it was sort of somewhere in that 3.6 to 6.6 mark, with the majority of people sort of looking around about 5%. Now, typically in places like Sydney and Melbourne, we're sort of taught to believe that those kinds of yields aren't necessarily available, but the real benefit is that yes, the yields might be a little bit lower, but the capital growth prospects are better. Where does sort of yields fit if we're talking, houses or townhouses in suburbs that you would recommend as being kind of investment grade properties?
Yeah, no, it's a good question and survey. I feel that yes, you do get more growth in the capital cities. You also should have lower vacancy rates, which is important post-purchase for investment. And also, I guess, the demographics of tenants in the metro areas and long-term benefits of supply and demand. The demand will keep increasing with population growth. So that's important to take into account. But that for houses in the metro areas, say if we're using that 30 to 50 kilometre radius that we discussed, for houses, and if land component and values there, say 450 square metres plus, you're probably looking between that 3 to 4% yield average. With the types of properties and purchase acquisition costs for a house that doesn't need too much work, might need some cosmetic updates and some electrical plumbing improvements, but structurally should be okay. The cost that you pay, you should be seeing around that 3 to 4% yield. Larger land components and closer in the metro, maybe the 20 to 30, inside the 20k radius. So 0 to 20k, you might even get lower yield, 2.5, 2%, because you're going to have the growth and higher acquisition costs. If you're looking at villa units and good townhouses that we purchase in established areas, you might see higher yield, 4 to 5%. Otherwise, to get that 6, you've got to start looking at other assets, maybe in regional, the major regional cities in Victoria. And like we specialise more northwest, and where that affordability is there for investors and owner occupiers sub 1 million. The colleagues and associates in buyers advocacy around Victoria that might specialise Bayside or southeastern suburbs and eastern suburbs, obviously yields might be a bit lower because acquisition cost is higher, but they'd have other opinions there as well of what you can achieve for investment and other benefits too.
Yeah, and I suppose everyone's got different strategies, and if you're looking at your first investment property or your 10th investment property, you're probably talking some different things, but there's certainly plenty of opportunities in that kind of northwestern area, and I think in some respects it's undervalued compared to the east, but there's a real east versus west kind of thing going on in Melbourne, right, that perhaps us non-Melburnians don't understand.
Yeah, and it may change, with one infrastructure improvements, which is slowly improving, but thanks to the government, that's another topic. Things get put on hold or under review, but and population growth will improve it. Regentrifying, people just pushed out purely based on affordability. They'll start to look over the north side and west side. We see those first home buyers coming across, even from Sydney. In the last decade, I've seen more deciding to rent vest in Melbourne, and generally, if they're living, working, renting in Sydney, then they might rent vest in Melbourne under $1 million, forget all the first home buy incentives, and buy in the northwest. And they're already seeing growth now and improvement. So the growth based on time in the market, the yield will be beneficial, based on your purchase price or the time that you purchased.
And just looking at some of the median value data, I mean, I mentioned before that places like Sydney and Melbourne have typically had a much higher price point. So it's kind of the opinion that you'd be of the opinion that you need to go regional or other areas to get something at a lower price point. But just looking at the median value for Melbourne versus Brisbane, we're talking Melbourne's 766, where Brisbane is 735, and even Adelaide is 671. It's not that much of a difference now between Melbourne and Brisbane. And a lot of people have kind of talked about Brisbane for probably 10 years before it boomed. Like, it was so much cheaper than Sydney and Melbourne, so it just has to move. But it didn't. It sat still for a long, long time. Do you think that sort of the median price point has any influence as to whether people pick to go Sydney or Brisbane or Melbourne? The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
I think that it has, when they initially look at a high level, they'll look at where they can budget, and first, if they can, afford houses. Everyone wants to, secure a house first, then, good size, maybe dual occupancies and townhouses and units. Definitely, I've seen that discussion over the years with Brisbane and the appeal for Brisbane. And you're right, 10 years ago, it was cheaper to buy there than rent. It was very attractive, and then everyone jumped on it. And so, we don't buy interstate ourselves. We'll refer out to colleagues or peers that we trust interstate. But Victoria, where we're licensed, we'll get hands on and search, inspect, and do all the due diligence here in purchasing. But I feel that the question about what they can buy and how much maintenance long term, especially with the reforms around the rental properties in Victoria, that sometimes affects, beyond looking at median prices or what you can buy, that affects the decision of which state they're going to buy an investment in. So we've had a lot more owner-occupiers as clients over the last few years, and investors starting to now look at the market if it seems as though we've reached the bottom, and in the the outlook for more improvement in maybe some reasonable, sustainable growth, we're starting to get that discussion back with investors again, but where there might be some opportunity in Victoria.
That's a really good segue. I want to talk about legislation and really before, I think even the minimum standards and certainly the land tax questions that we had, we looked at the percentage of people purchasing in Victoria versus New South Wales versus Queensland. And of the three, Victoria was the poor cousin at around about 11% of investors picking that one, as distinct from about 22 in New South Wales and peaking at over 40% in Queensland. What do you think was making that state or the state of Victoria less attractive at that point in time prior to the legislation? Or was there already rumblings that people were seeing, like the minimum standards, like rent freezes? I mean, how long has that discussion been going for?
the minimum standards has been several years. Like, there was warning, of it for many years and discussion, and then it was, implemented in 2001, compacted with the lockdowns, and they stated that, it will be enforced as of 2023 with all the minimum standards. So that was already affecting investors that, I guess, ones that were looking at exiting the market maybe in 5 years or so, or retiring and cashing in with 5 years, they were starting to accelerate that process and thinking, well, we're out. I'm not going to spend 20 or 50,000 fixing this home, because it's one thing to get the minimum standards checked. Get a plumber in, get an electrician, building inspectors. That might cost you $1,000 to $1,500. It's the subsequent estimates. And yourself, with your skills as a quantity surveyor, that's what scares most investors, is the bill shock of what needs to be done, the vacancy loss, getting the tenants out while it's not at standard, and then the loss there of holding costs with high interest. It was just, I guess, too many things compounding each year, when there should have been good policy discussions about how do we incentivize investors to keep supplying the market. We already had an exodus of people leaving Victoria, not just because they, not just the owner occupiers from lockdown, but also people scared to invest when we had inspections shut down for almost 6 months, or limitations on and off without any certainty of when things would be freed up for people to come and rent and inspect properties. So there was a lot of concern, and without any clarity, that creates fear.
Yeah, and I think when it came to the COVID response, there was Victoria and then the rest of Australia, right? Mr. Andrews got very stuck in there, and I think you guys were internationally ranked as one of the highest lockdown locations in the world, which is, I think contributed to scaring people away from the state. But on top of that, we've also had some land tax changes. Now, have those been legislated as yet, and what impact do you see those as having?
Some clients and investors are already receiving higher than expected land tax bills, which has forced an increase. And if you speak to most sales agents, the impact of the higher interest rates coming out of all the rental reforms, the land tax, discussions, and raising land tax and even council rates, they're getting a higher than normal level of inquiry or appraisals, and people listing properties for sale that were their long-term investors. So from their actual rent roll list of clients, I think after the Victorian state budget, there was an increase of like 70% inquiries from landlords contacting their sales agencies, or contacting advocates that work as vendor advocates to see what their property would be worth, how the process of selling, and or just concern about how these land tax and other costs are going to affect them, that they just can't sustain long term. So that's supply coming out of the market. Plus long-term investors and builders. Like, we deal with a lot of smaller developers, 4 to 6 unit sites, that the cost to acquire, risks of not being able to get lending for construction at reasonable rates, second, third tier lenders, or no lending at all for construction, and other holding costs. They just can't supply the market with investment property anymore. So there's a big combination there that the government really have to start thinking a little bit more with a longer scope or a longer lens, and creating incentives to have this private sector of investment property supply step up quickly.
And all of those things that you mentioned have been disastrous for the supply of rental properties in Victoria, and we're at crisis levels. So the government can talk about supply, but they're talking about building, not necessarily nurturing the supply that's already in there from not selling. And I'm really interested to hear your viewpoints on this as the state representative of the Real Estate Buyers Agents Association, and a candidate for the board of the Real Estate Institute of Victoria as at the time of recording. I'm sure once this goes live, you'll be newly minted, and we wish you all the best with that. But the REIV in particular have put some great material out there on rental freezes, and we just had the National Cabinet meet yesterday, as at the time of recording, and the Labor government has basically said no, there won't be a 2-year rental freeze. We already have 1 year kind of rental increase caps in many states across the country, and I guess they're going to mandate that as a national thing, but they are talking about, the increasing the supply and building, say, 240,000 homes a year over the next 5 years. Where do you see the state of that dialogue and the level of education of the people that are proposing some of these policies? And can you give us your broad thoughts on it, Mark?
It is great to have promises, but they have to be realistic. And my thought is how fast, and if they haven't been able to, over the last few decades, supply enough social housing, the migration issues, we were already locked with migration. It's barely picking up now, and the demand is there that we need more housing now, especially in the rental market. Most migrants need to rent for a few years before they're capable of buying. The construction issues, we've seen, major volume builders that had contracts like Metricon need to be saved by the government and taxpayers with contracts to supply social housing. There's also town planning issues. There's not enough town planners there to get these things to speed as well with the private sector. Forget the social housing sector, but even with the private sector, there's not enough speed on town planning reform. So that's meant to be reviewed, and the government's even discussing taking that away from local municipalities and bringing it into a government that's not doing the job with the things they've got at hand in their portfolios at the moment. So I'm quite concerned about how realistic it is that they're going to, yes, great not to put the rent freeze in and have that discussion now to take the fear out of consumers, because they'll just paralyse and not make any decision, not purchase investment, not purchase to occupy. But I think the building chain and the actual construction industry and costs with construction and speed there, I don't see it happening soon enough. It needs to be a combination with, yes, keep the focus on the social housing development and keep going with that, even with a bigger plan and more properties to be constructed by government, but at the same time create policies that make stronger incentives for investors and private ownership and supply the rental market. It will naturally, with more supply in the rental market and private rental market with private owners, it will naturally reduce the cost of rental properties and keep it at a more even competitive rate so more people can afford to rent. And property investors won't care if costs reduce slightly if they're getting tax incentives and benefits to supply and own investment property. It's a balance there. Sorry, I went on a little bit, but it's the topic that there's a lot to discuss.
Oh, yeah, absolutely. We could probably do a 10-part series on this, Mark. No, but I appreciate your insights there. I think from my perspective, the commentary in and around the National Cabinet ignored the fact that, there's lots of numbers thrown around, but somewhere around 81% of private of rental accommodation is managed by the private sector. But there was no discussion about the role that they're playing, whether they are incentivised or disincentivised. I think there's a fairly strong argument to say they've been disincentivised both in individual states and nationally by many of these rent freeze rhetorics. But thankfully, the government was clever enough to realise that would make things worse in the long term. Why do you think investors really haven't even got a mention in respect to the part that they play for rental affordability?
It tends to be overlooked. I know, the rent freeze campaign from the REIV that was published last week as well, that was actually well considered and researched, and even comments on how the rent freeze issues hadn't worked overseas. But they did mention about the private sector and that the private landlords and private investors or private rental providers, the correct term in Victoria now, do supply most of that rental market. But there will be, I think, a lot of discussion raised if they mention it, because that there's going to be a void with the amount of private investors looking to leave the market, with the expenses and pressure on them from not just the land taxes, the interest rates, the other maintenance issues and costs of retaining an investment property. That's going to be reduced significantly if more investors keep exiting the market. So it's going to open up a bigger can of worms that I don't think they were prepared to. That's my personal opinion. They weren't prepared to answer or have answers for.
Yeah, I suppose a commitment to build more homes, or at least try to build more homes, is great. But for all the issues that you raise, a shortage of planners and certifiers, construction costs being a little bit higher than we would like to be dealing with, the availability of finance and developers feeling comfortable that they're going to be able to make a profit. Those things combined with international migration has ramped back up. The household occupant ratio has gone down from something like 2.6 to 2.56 or something like that. Don't quote me on that, but that's actually resulted in an extra 140,000 homes required, because less people are living in properties with divorce and all sorts of things like that. When you add all of those things up together, do you think we've got a chance of solving this with the policies we have in place in the moment, or can it only just get worse?
The policies in place at the moment don't help, and they only add to the issue. But the government's proven in times of need and crisis, like the lockdowns, that if they want to change policies, they can get together and do it quickly, overnight. We don't need long meetings and discussions where there's people with different opinions. That needs to be that the focus on assisting to ease some pressure on the private investors so that people have somewhere to live, and there's going to be less risk with homelessness and pressures. There's been discussions that and even studies overseas where if there's too much pressure on the private rental market or housing supply, then it creates a black market of renters that can afford the properties that are available, taking advantage of private tenants paying them overpriced fees just to get a room, just to get bored, and they're not going to be managed by professionals like professional property managers or owners that are under concern and needing to cooperate and deal with the legislation requirements, because you're going to have tenants doing unlawful tenancies between each other, property conditions, and even with all these risks with construction, there's also still the labour issue, the labour shortage or labour costs to construct as well. That's another issue.
Absolutely.
And I've noticed even a lot of the town planners from the local municipalities being offered positions with state government infrastructure projects. So that's created a shortage on town planners that are skilled, which is great. They're needed. Infrastructure is needed. But there's a lot of movings about in different sectors, which is creating pressure on this normal residential housing supply. So without going off topic too much, I think that if they look at the tax reforms on investors quickly, there's been discussion, not just REIV, other peak associations and bodies mentioning that, stamp duty is seen as a lazy tax. It's a big revenue for the government, but there's other ways, there's other discussions to raise and acquire the similar amount of revenue without it affecting just one percentage of property owners or private property investors, which are struggling to keep that investment property anyway. Most are just one investment owner, mum and dads that have struggled to get one investment property. There could be ways to look at maybe increasing GST slightly, where everybody wears it. We're all collective in this country, and be able to still maintain the same levels of revenue, reduce the stamp duty.
Yeah, stamp duty is such a huge component of state revenues, yet it really disincentivises people from shifting when the property is no longer sort of sufficient for them or adequate. It's the age-old story of the little old lady in the 5-bedroom house, right?
Yeah, or sitting on an investment property that doesn't meet our state's minimum standards, and they've got vacant properties around just because they can't afford to fix them and rent them, and they don't know if they can sell them yet. They're in a fortunate position that they're not forced to sell. So there's a lot of vacant dwellings out there.
Yeah, which just seems crazy when we're talking about, so many more people becoming homeless every day, and that's the real thing that we need to, I guess, to keep motivating us to discuss and work on this, because that's a real human cost and a pretty sad state of affairs. So in that regard, I wish you all the best in your advocacy work, Mark, and I appreciate the work that you're doing, and I recommend anyone that's in the property investment game should be following Mark at Master Advocates. Master Advocates, that was a mouthful on my perspective. Apologies for that. But thank you very much for sharing those thoughts in and around policy at the moment, Mark, and giving us a lay of the land of Melbourne as well.
No, thank you. Thanks for having me. Pleasure to have a chat with you like always.
We'll have you back for sure. Cheers, Mark.